Hi, this is Soumya Sarkar from Redefine. Yesterday we had seen the budget, though it's an interim budget, but it had given some very basic advantages to the Indian market and the bond yields. So a lot of clients ask me about that what will be the impact of the lower physical deficit. The government has made the deficit, which 5.8 was last year. Now they have decided to bring it to 5.1 this year. That means the government is slow on the borrowing. When government is slow on the borrowing, that means definitely it is going forward a very healthy, prudent economy. And because the government is lowering the borrowing, obviously we can see there is a softening position of the yields. So bond yield will start becoming more softer over the period of time. And we have already seen it yesterday that bond yield had come down significantly after this budget announcement. How it has helped to the investor? The investor who are holding the money into medium term or long term bond will see a significant increase in their portfolio returns or long term bond returns. Liquid or overnight fund may not be that impacted, but people who are into dynamic bond fund or a medium term or a long term bond fund or gilt funds will definitely have a good return due to this softening position. Now, how I see this falling bond yield in the coming months, I think that inflation is already under control. The RBI has maintained its status quo position for almost 1 year now. And another important part is that yesterday's budget announcement. So it is actually fueling the bond rally, I think, which may sustain for another 1 or 2 years and can generate a definitely good return for the investors who are holding the long-term bond as well as the medium-term bonds. It will also affect the equity market because when the bond yields are going to come down, so cost of borrowing will also come down. So once the cost of borrowing is going to come down, definitely that money will flow into the equity market, and we can see a significant movement in terms of equity market also. Though we have gone beyond the fundamental in the equity market, hence there is a chance that we may not see a massive rally like last year in this year, but definitely softening bond yield will definitely going to help the equity market. US has also informed that the rate hikes are almost over for them, and we may see a rate cut before the presidential election in 2024. So definitely that is also going to add a lot of money to the emerging market, and will this kind of bond yields for India also is going to help. So overall, I think this is a very good time for the investor to hold their money into medium term to long term bonds. Investors actually in last 3-4 years could not make money in the long term or medium term bond because of the high interest rate. But now it is time that there are so many signals which are coming that falling yields are going to sustain, and there will be no spike in the yield in a short or a long term basis, and long term and medium term bond holders will definitely get the best benefit out of it. Thank you for watching the video. We'll come up with this kind of technical things on a regular basis. If you like it, please click the like button, and if you want to subscribe to the channel, please do subscribe. Please remember, this is only for the educational purpose. You should not invest any money based on this analysis of bonds or whatever it is. If you want to really invest the money, you should talk to your financial advisor, and financial advisor should help you to invest the money. This video doesn't tell you to invest the money any of the bonds or mutual fund or stocks. Thank you for watching.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.